Welcome. This is Noble Woods. Welcome to Insider Trading, the best, most amazing interactive live podcast on trading and investing that you can find. Welcome to the show. Today, we got a lot to cover. A lot to cover today. We need to go back to some basics. We got to go back to some trading, investing basics, 101, to build the right foundation. The longer I do this, I've been doing this about 13 years. I love trading. I love the intellectual exercise of it all. I love business and thinking about innovation and what's going to lead the future and problem solving and what do people really want? Where's the economy going? It's such an amazing, there's so many variables. And every day is a new day. So it's just an amazing space. This is where all the money's made, in the markets. So you're watching the right show. I don't know where you are, who you are, but we're going to go back to some basics today. Because right now there's a lot of advice. 2020 birthed 1,000 billion trillion new experts that were not trading or investing or really doing anything before 2020. Y'all see a lot of these people just popped up. You never seen them because they made a little bit of money. They thought, I can be an expert. I can teach other people how to do this. And this really requires time. So I want to go back in time. I don't want you to take my advice. I want to show you how this actually works. We're going to do a couple things. We're going to start talking about trends, basics of trends. I want to go back just a little bit to the recession in the dot-com bubble bursting to show you how similar it is to where we are right now. Every single downtrend on the month chart that happens is a recession. If you can identify a downtrend and you're smart enough to actually look on the month chart, you'll be right there going the right direction, able to make money, even when the market is down. The crazy thing about, I use Thinkorswim. Crazy thing about Thinkorswim, you can pull up the SPX. You can go all the way back to 1929. You can go back to 1929. There's that much data. So you literally can go back 100 years almost. You're going to see the same thing happening over and over. Nothing's new. I know this period right now is very uncomfortable. It's unsettling. It's unpredictable, but nothing's new. And I want to show you. I won't just tell you. So we got to talk about trends. I want to show you some of the big tech stocks that right now are hitting new lows, 40, 50, 60%, 80% down. What does that mean? Why should that worry you? Why should that also make you excited? If we're talking about investing versus trading, investing long-term, I'm buying companies today that I believe 10 years from now, 20 years from now, will actually still be amazing companies, will be dominant. Here's what nobody tells you. Picking stocks is incredibly challenging. Ooh, it's challenging. I'm sorry. If you have no business background, you can't even explain the basics of a balance sheet. We start talking fundamentals and financials, you just kind of zone out because you really don't really do business. Business is about numbers, right? So, unfortunately, it's so easy to get into this and just pick something. Pick what you like. Oh, shoot, let me get in a little bit of Zoom and a little bit of Clorox. Oh, Clorox was popping. What else is going up right now when COVID started? What else? Well, Peloton, let me put that on my list too. People sitting at home, riding their bikes. What else? Everybody was using Clorox. Oh, Zoom. Oh my goodness, Zoom. These are great investments, right? Nope. And I told y'all back then they weren't. They were momentary. They were very amazing opportunities for very technical traders who knew when to get in and when to get out. And you got to see a chart to know that. I'm going to show you when you should have got out. We're going to talk about the Fed's report yesterday. Jerome Powell. He said slower, but not lower. He said slower, but not lower. Now the crazy part about this, I don't want to give you an MBA level, explanation on, these microeconomics and what the Fed does and inflation and all these things. I'm gonna keep it real simple. I try to keep this like high school simple. I really do. But as he's saying, we gotta bump up interest rates a little bit. There's a max we can go to. We're not there yet. We can raise it higher. We probably are. You think the market's digested that? Oh, it's already built into price. We already knew it was gonna go higher, right? As he's saying it, price shot up. When they got to the, a little bit about maybe I don't know, I'll pull it up on the chart and show you. 20, 30 minutes in, markets start crashing. So he's saying we're going to go slower, but not lower, as we're going lower. As price for the day starts to hit new lows, and the market is saying, market's reacting. I want to show you the daily and the weekly 200. They're really simple indicators you have to have on your chart. Whether you're an investor or a trader, I'm sorry. You wanted to step into this world, you got to get serious, because you got people like me on the other side of your trade. And I guarantee you, if it comes down to me or your money, I want the money. Right? Every time you lose a trade, somebody's taking that money. Like, the market's brutal. The market don't care about you. Don't care about your feelings. Don't care how you feel about yourself. It's about the trade and who understood the core mechanics of what this is. When you look at a chart, it's data analysis. That's all a pricing chart is. It's data. And behind it, there are two fundamental principles, core pieces that make trading and investing, I'd say, challenging, fun, just depends on how you look at it. It's uncertainty and variability, which are actually the same two core principles under statistics. Why do I know that? Because I love stats. I got A's in stats, undergrad and grad. And I was just this past week in my options class. I'm teaching a live 8 weeks options class. We're getting into systems, my technical system. It took me 13 years to develop this system. Amazingly high win rate. I don't even want to say the percentage, because you're going to think I'm just talking. You're just going to think I'm just talking to be talking. 13 years. Like, I've spent a decade of my life trying to master and understand this for what it would do for myself, my family, and future generations, along with all the people that I can help educating, because I break things down well. Right. So we got to talk about some statistics, just a little bit. Probability. Because there's uncertainty. You don't know what's coming tomorrow. I don't know what's coming tomorrow. I don't care how smart you are. I don't care what podcast you watch. I don't care how confident the person talks, whether they on TV, your friend. I don't care what the CEO said. Nobody knows exactly what tomorrow's going to bring. Because when earthquakes happen, markets drop. You couldn't predict no earthquake. When corruption happens in corporations, things drop. You didn't see that corruption coming. You didn't see it coming. All these little reports that we've been getting lately, all they've been doing is kind of pulling the market down, but we've been bearish since January. All right. Which is why I call this, we're still bearish. We're still bearish. That's all you can know. What do you know? What do you know for a fact? You don't know what's coming tomorrow. You don't know where we're going to be 6 months from now. You don't know where we're going to be a year. All you know is where we are right now. Are we bullish or bearish right now? We're bearish. Now, you hope we, right? You hope we get back to the highs by the end of the year. Okay, I understand your hope, but that's hope. So let's be clear about hope versus like literally what price is showing you. All right, we've been doing this. It's actually been a very simple year. I hate to say that. 2020 to 2022, very simple uptrend. Higher highs, pull back, higher highs, pull back, higher highs, pull back. December, matter of fact, man, let me pull these charts up. I'm gonna stop talking. Let me pull my charts up. Give me 1 second. I'm gonna go here. Oh no, I want to put me in the corner. There we go. No, I'm gonna put me. There we go. Okay, all right. Okay, so let's do this. I got a couple things to cover. I want to start with the SPX, which is the S&P 500. All right. I'm gonna take everything off my chart real quick. For those who are like, man, I don't know how to read these candles. What the heck is this? It's real simple. Your kids could read them. And I know because I teach kids. I actually got a session with some kids. What is that? Jack and Jill? The organization, a lot of moms, run it. different. I know there's like one main like kind of Jack and Jills, and then there's like these smaller ones, and then you gotta like after you go through a certain level of, I don't know, checklist, then you become like an official chapter. So, you know, I love Jack and Jills because several of those moms over the years have called me and said, "Hey, can you come in and do something for our kids?" Yeah, I can. All right. So that's coming up in November. I'm excited. This is the S&P, y'all. This is the S&P. What is this right here? What is this right here? This downtrend that you see. So these green candles, each candle represents a month. All right. If it's green, price went up in that month. I'm gonna keep it super simple. 5th grade simple. I said high school. We're gonna bring it down to 5th grade. And I literally started teaching Limitless. Limitless was a middle school 5th, 6th, 7th, 8th grade class 12 years ago at the Ron Clark Academy for free. I did it for 3 semesters. Shout out to Dr. Valerie Jones, who helped me to get connected. Ron Clark, shout out to him too. Let me come in and, you know, teach the kids. It was mind blowing. Taught me a lot about what was possible, right? So, once again, green candles are up. That means in this candle right here, price went from 29. At the end of that month, it was 31. This big red candle, it means price was at 30 by the end of that month. We went as low as 20. But when this month closed, we were at 24. These long lines are called wicks. Don't even worry about the wicks. Just look at the green and red. Red is down, green is up, right? So what is this? This is actually, this is the Depression. This is the Great Depression. Back in 2029. I mean 2029. 1929. 1929. So we're gonna fast forward. And let me just show you something. So right here. All right. From 29 and 33. Really, really deep recession. Great Depression. I'm sorry. Then what happened? We got a couple years there, right, of buying. Look at this. From 50. Oh my God. Look at this, y'all. From 50 to what is this? This right here, this low, this line right here. This is 1950. From 50 to 70, we had 20 years. 20 years of what's called a bullish market. All right. 20 years. Had some bouncing around, kind of hit those same lows, right? Hit those same lows back here again, right? So you got a little floor there. All right, 80 to let's see. I'm gonna show y'all these huge macro trends from that crash in 87 all the way to 2000. Price went from 20 what is this? $200, 250 on the SPX on the S&P up to 1500. What kind of percent is that? It's crazy, but 600% return. All right. Now that's over a period of years. So what happened right in here? Well, this is what I want to focus on. All right. This was the dot-com bubble bursting. And this here, this, my friends, was the recession of 08. Dot-com bubble bursting, recession of 08. All right. I'm going to add one little indicator real quick. Super powerful. It's amazing. This is the basic form of it. I purchased the more advanced one. I don't even pull it up because I don't even want to explain it. And the basic one is enough to do some damage. I just want to show you this. All right, so check this out. So, see these red bars down here? They mean something. They're telling you something about volatility. All right. What you can see is once we got that first red dot, the market continued to go in this downtrend. This is the dot-com bubble bursting. Eventually, we got out of there. You'll see here, we got a little blue bar. A little blue dot right there. And this went back into an uptrend. Look at that. Where did it go? Price essentially went back to the exact same highs. This is called a resistance area. Some of y'all call it supply and demand zones. I know there's a million different terms. It's all the same stuff, right? And then here we have the recession of 08. And what do you notice? Same thing. Same exact thing. Longer charts. These longer charts give you a better view of the world. So many of y'all are just like, you're so deeply staring at day charts all day. You're staring at day charts all day. The day chart doesn't give you the broader picture. It really just tells you what you can expect for the next week or so. All right. So if you just want to make money over the next 10, 15 days, okay, cool. Use a day chart. But as we start talking bigger, broader picture, you have to go to bigger charts, week chart, month chart. I've seen every educator out that has the gall. I was about to say the balls. I should have said it. I did. That has the balls to go live and analyze like live in front of people. Most people not using a month or the week. Everything's super small. And it's so much. I'm telling y'all, it's so much easier to see things clearly when you start your analysis with these bigger views. It really is. It really is. It's like dating. Anybody can act like the world's greatest little, bae for like 1 or 2 days, a week or two. No, you learn somebody by seeing them over time. All right. Let me just be your friend first for a month, a couple months, for a couple years. That's how you really get to know somebody. All right. We don't do that. We love the same way we trade. We just want to get in there as fast as possible. We want that return as fast as possible. And you don't know enough about the market or her or him that fast. You don't. You just don't. So, what do you notice here? First red dot. The TCM squeeze, which is it's actually two really dope indicators combined. One of them is called a Bollinger Band. A little bit of statistics in there. There's a 20 period. Oh, let me do that. Let me add the 20 period moving average. No, I ain't gonna even do that. No, I'm gonna add the 20. I'm gonna add the 20. I'm gonna add the 20. I am. I'm gonna add the 20. Just a little bit of technical stuff. Just a little. Nothing major. Let me take that off and then let me change this to, I'll make it a 2. Okay. So think about this for a second. In every class you've ever taken, there's like an average. There's certain people that are hitting the average, certain students that are below the average. Right now in the NBA, I know just season just getting started, but there's an average for every single player. What is their average? All right. There's a higher, and if you're above average and above the average of everybody else, you're an all-star. You're below the average, consistently below the average, you're not going to be somebody we even really talk about, right, as sports fans. It's the same thing with price. And that's basic statistics, right? So Bollinger Bands was one of my first little favorite indicators. If you dig into it, what you'll learn is that it gives you a midline. And same thing, if you've ever taken a statistics class in anything you've ever taken, there's going to be an average in every pool of data, whether it's prices or grades or COVID tests or anything. There's an average. What's the average? Right? Why is the average so important? Because to be above average, you got to know the average. All right. So this little yellow line, it takes the last 20 periods, adds them up, divides by 20, plots a little line. This line is moving. It's called a 20 period moving average. It's actually the statistical 50% statistically on your chart. What does that mean? When price is under this yellow line, price, the health of the S&P is below average. S&P is starting to get sick when we go under the 20. It's basic. It's not something you can argue. It's basic math. It's literally statistics. Statistics is a language. Math is a language. All right. What do you see? What do you see? Wasn't this recession under the 20? Squeeze turned red. We pulled up to test the 20 here. We tested the 20. What does testing mean? It just means we went up to touch it to see if we could get back above it right here. All right, what month was that? That was May 2008. Went into a downtrend. It was already telling us it was a downtrend was potentially coming when it went under the 20. The squeeze turning red just confirmed it. And then we got the strongest part of this volatility as everybody else realized, oh, yeah, it is real bad. All right. If I go back to the .com bubble bursting, it's the same exact pattern. We went under the 20. Then the squeeze turned red. We made a little push right here. We tried to push back up. This is what all y'all bears who are delusional, who just every time we push up, you think we're going into an uptrend. All right. This little push up, drop, push up, drop. Then we finally, as this ended, we got above the 20. All right. So we went under the 20 November 2011. We didn't get back above it until June 03. That's 3 years. Recession 08. We went under the 20. Price went under the average. In January of 08, we didn't get back above it firmly until November 09. All right. So that's almost 2 years. Where are we right now? What do y'all see? Where are we right now? Do we have some red bars down here? Yep. Have we been under this average? Yep. And did we test the 20? Yeah, right here this month we did, which was August. We pushed up. So here's what I can tell you. Factually, mathematically, this ain't Noble's opinion. This is Noble, who has an MBA, who's been through 7 years of B school. It took me 5 to get out of undergrad. Shout out to anybody watching from IU, Indiana University. And I got my MBA, Clark Atlanta. That's 7 years of B school. But I love stats because I flunked it first. Right? Teacher that taught it couldn't really teach. Learned it in this huge lecture room out on IU's campus. What was that, Ballantyne Hall? I forget what hall that was. I think it was Ballantyne. It's like 350 people in the class. I used to go to the little labs. I couldn't figure out what the hell they was talking about. I flunked it proudly. I tried, but I flunked. I took stats again in the summer. Lady had a Russian accent. Wasn't even speaking that good of English. Got an A. Why? Because she could break it down slowly. She could break it down slowly. Right? So this to me, like I view the market as somebody who has a business background, statistics core to me. And I love the math and how this stuff works. Y'all be making it too hard. Y'all really do. I know everybody's betting and waiting, and right. And we're constantly trying to figure out what's coming next. So I get that. You always want to be ahead, true. But you also got to be in the present. You got to be in the present. So let me go to the week chart real quick. Let me hit some other stocks, show you some other stuff real quick. I'll take all this off my chart. So what do you notice here? The same pattern, different time frame. This is the week chart. All right, where'd the squeeze go red? Right here. And we were already under the 20. Already under the 20. I did some lives back. You literally can go back. I love making these types of posts because it's really just tracking a record in my head, right? I went live a couple times, like back in here. And I was saying, like, yo, we're ranging. We're inside this range. We made a new high, but couldn't break it. We didn't get any follow through. When we start ranging, I don't care if it's the 1 minute, the 5, the day, the month. I don't care. Once we start going into a tight range where nobody's really putting size on the table, buying or selling mass in large lots, like billions of dollars going in or out, we got to go one way or the other at some point. We still got to go one way or the other. What did we do? We dropped. We went down. We broke out. We broke out to the downside. And then what did we do? We pulled up. We tested the 20. And we dropped. And then right here, we got above the 24 second. And right here under this candle, we went right back down. So we had 1, 2, 3, 4, 5. We've only had 5 weeks this entire year that have literally been above the average. Why is the whole world like why are y'all so anticipating and so ready for stuff to be bullish? We're not bullish. That's why I call this we're bearish. We're still bearish. Like we just bearish. I don't know what you want to happen. We're bearish until we're not. We just are. Once again, all the talking heads, I don't care who it is. I don't care what they're saying. This is statistics and math. So I don't care how much money you got. I don't care how many followers you have. None of that stuff matters. This is math. Every single downtrend on the month chart, right, follows the same basic patterns, same basic statistics. Math ain't gonna change because the market changes. All right, it's not. Oh, and then let me do this real quick. Let me pop out for just a second. Let me show y'all this because this will be kind of cool to show you real quick. So this is that period. This is let me kind of draw it out this way. This right here, recession of 08. All right. This period here, getting above the 20, I call the reversal, and then you had a true uptrend here because we're now establishing higher highs and higher lows. So this was the uptrend, right? So think about this for a second. You had a 2-year downtrend. It took a year to get back to normal, back above the 20, back into the above average probability area on any chart, right? Then took about another year for us to make new highs. Okay, cool. We're excited. Then we got a rough couple months in here, which already still we were in an uptrend. And then we got a nice, really clean, smooth, just every single month going higher from these lows of what? 2011 to 16. So we had 2 bad years, a year and a half of some struggle, and then 2 amazing years. This is what you learn when you look at these longer term charts. Y'all be driving me. People drive me crazy. Every other day, it's a new prediction. Every other day, it's like, where's the market going? Every little report, every little thing that moves us. That's not how this works. It's not. We don't go from a downtrend on the month chart and the week chart to being bullish in a day or a week or 1 month. One good month is not putting us back in an uptrend. It's not. One good week is not. One good day is not. It's not. So we're not bullish. Even if tomorrow's bullish, tomorrow's not bullish. It's not, man. Let's look at some tech stocks real quick. These are concerning. They are. I'm gonna start with Amazon. Take everything off my chart. Good on Amazon, man. Sheesh. What is Amazon down for the year? These highs are 188. So it looks like as of today, Amazon's down 52%. And if you look at where, let me pop this back up. Oh, y'all can't see my charts. Hold on. I do that all the time. I'll go back to the chart and forget y'all can't see me. My bad. But check this out. So this is Amazon down 52% for the year. COVID was right here. This is the low. All right, matter of fact, let me show y'all. I literally been saying this. Godly. And it's not about me. I just know that I know that I know. It's going to be incredibly hard for you to find somebody that spent more time on technical analysis, charts, and who understands the math, who also has a business background. That's rare. And I'm a black male. I'm sorry. Find a person who spent more than 13 years every single day. All right. Why do I say that? I've been saying since we had this, since the market started to come down. I got a video on it. What did I say? I said you should expect a lot of stocks to go back to their COVID low. And this was even before the downtrend started. Why? Larger macro level patterns. That's all. It's not because I'm super smart. It's because I put the time in, and that's just what happens all the time. Those 2 major recessions I showed you, they were 50% pullbacks. If you draw a line from the high on the S&P to 50% this time around, it's the COVID low. It's the COVID low. I've been saying this all year. Now, some stocks are already in a recession, right? Amazon's already in it. It's well into Amazon's recession. It's all the way back at the COVID lows. How many months of growth is that we just erased? If you draw these lines, you can get a lot done. If I go back to COVID, that is 33 months. 33 months. Right? So to do it a different way, I'll do it like this. From this COVID low to the high, it took us, that was 17 months. From that high to where we are now, 17 months. Y'all see that? So Amazon went 17 months of bullish activity, and then we turned around. We're almost back where we started, back at the COVID lows. That's Amazon. Google, where's Google? Not there yet. Where's the COVID lows? Right here. Right here. Right here. How much are we down? Let's see. As of today, 45%. Are we under the 20? Yep. Did we try to get back above it right in here? Yep. Could we get any higher than this doji candle? Nope. So we ranged. You should have saw this. I'm just, once again, you see this stuff real clear when you look on the month. It makes everything else easier. Look at this little candle right here. This doji. It's literally that's 101 stuff. A doji is a sign of confusion. The market is confused. What do you expect when you get a doji on a month? You expect a range. You expect for the market to range. And what did we do? We tested the high of that area, which was right there at the 20. We closed bearish. We're going back to the low. Happens on everything, every single day. Like, these patterns are so basic. But this is a longer term chart. All right, so you got a lot more time to analyze it, but you also got a lot more time to talk yourself out of it because you're going to hear so much stuff. Right? You can hear so much stuff in the interim. You know, the charts are pretty clear. They really are. Look at Facebook. Facebook has already, this is COVID. This is COVID's low. So yeah, Facebook has it's like beyond a recession. It's already deep into a recession. That's all it is. Some stocks right now are content. They are with the broad market. Some stocks are already where hopefully we won't get there, but we probably will. They're already where the market is going. It's literally a preview of what's coming. Charts don't lie. People do. That's one of the oldest things I heard since I've been in this game. Charts don't lie. People do. Why do we say that? Because everybody has an opinion. Forget your opinion. Forget your opinion, man. I care about the math. Because the math is going to give me the probability. Right? And that's what statistics is. We talk about high probability trades. How are we talking about high probability trades? But nothing on your chart relates to statistics. You don't have any indicators that literally are giving you a statistical edge with any of this. It's crazy. You know, this is why I teach, because there's so many people who just legitimately need the help. You know, and it's tough. Like, I never am one of those people who try to act like trading is simple. Investing technically is. It really is. Matter of fact, investing. Let me go back real quick for a second. Real quick. I'm gonna go back to the S&P. Y'all know what I did recently? I did this. There's a couple of calculators I use. So I said, what if I ran 3 scenarios? I said, what if you bought, matter of fact, I use NASDAQ. Oh, there we go. I still got the numbers on my chart. Where is it at? Oh, it's all the way back here. Okay, yeah, I can show y'all. That's even better. I forgot I had all this on my chart. Even better. Wait, hold on. I'm gonna try to get it where you can see it. Okay, I gotta move these around a little bit, but here was the question. If you started buying, because a lot of people right now are like, man, is this a great time to buy or should I wait? If you're practicing what's called dollar cost averaging, which means you're buying, you're building equity, you're buying whatever stock you love. There's a multitude of apps that let you do this. You're like, man, I want to put $100 in the market every month. Kind of how I started, like back in, I don't know, 06, 05. When I really didn't even know what I was doing, but I knew enough. This is when they used to have old school Share Builder. For those of y'all who remember Share Builder. Share Builder. It was ahead of its time. All they let you do was do what 401k does. Right? Which is what? I took this little quiz. It said, yo, you don't have a high risk tolerance because you don't really know nothing. So you shouldn't have a high risk tolerance if you don't know a lot. Right? This is an intellectual sport. I say it all the time. That's my tagline. I invented that. You hear other people saying it now, but that's noble. I was investing $50 a month before grad school as a broke student. $10 went to DIA. I really didn't even know what the hell DIA was. It's the Dow Jones. And then I selected 2 stocks. I was investing in Google, $20 a month in Google and $20 a month in Apple. Why? Because I was in grad school. Everything I did was on Google. So I'm like, I might as well invest in Google, tech company, blah, blah, blah. Did a little bit of research. I didn't know that much about the market. And I just saw what Apple was doing. iPad. You know, well, actually, were we in the iPad yet? What was the old one? Before they came out with iTunes. You know, they revolutionized music. So I was like, yeah. And I had bought my first little iPhone. My first Mac. I don't even think the iPhone was out yet. Anyway, so yeah, so that was what I was doing. All right. And so when you're dollar cost averaging, you're just buying some every month. You don't have to get these perfect prices. I know there's people always constantly trying to make y'all feel like you need to buy and get these perfect prices. That's more technical. That's more advanced. It requires more discipline, skill set, time. All right. It's risky in a way because if you miss this perfect price, then what you gonna do? Right. So what 99% of people who have a 401k are doing is they're doing dollar cost averaging. It's taking a certain dollar amount every month, putting it into the market. So the 3 scenarios I ran simply were to say this. What if you put X amount? The amount doesn't even matter. That's the cool part. Percentages don't change. What if you start investing here as the recession started? What if you started putting some money in the Dow then? And then you carry that all the way till 2020. You know we had an amazing bullish run. What if you started before the recession? Was that a good idea, bad idea? Then I said, well, what if you started investing at the bottom? Now, nobody knows it was the bottom, right? Technically, but what if you perfectly started investing at the bottom? And then what if you said, man, forget all of that. I'm going to skip all of that. I'm going to wait until the market tells somebody like Noble or my charts are telling me we're back in an uptrend. Right. So I went March of 08, March of 09, March of 2010, just year after year after year. Right. And they just happen to work out. Pre-recession, bottom of recession, post-recession. If you invested X amount, whether that's $100, 50, 1,000, 10,000, whatever you can afford every month, what would the annual return be? If you started in March, and I think I did these to the highs. I don't think I did them to where we are now. I think I did them to the highs because I just wanted to get like the max, you know what I mean? Like the max return. But if you started in 08 to 22, December, I guess, of 2022, that's a 20.4% return every year, annually. If you got it perfectly at the bottom, okay, it's a little bit higher, 20.79. And then even if you wait it, it's 20.71. All right. What you should notice is all of these are so incredibly close. We're talking about not even 1%, literally not 1% of difference. Right. So I think if you did this on, once again, go back as far as you can go. y'all making this real difficult. Making this real difficult. If you're an investor, buy, relax, buy monthly. Don't worry about these perfect prices. Buy. It's built over time. It's built over time. You're not Warren Buffett. You're not Warren Buffett buying millions of shares at a specific price. Now, don't get me wrong. I'm talking the average, just, middle class folks who just want to build equity over time. If we start talking about you're doing well, you're in the top 2% of America. Okay, cool. Okay, yeah, maybe then we need to talk about specific prices and pullbacks and blah, blah. Okay, cool. But most people ain't, most people just trying to grow. Just trying to grow things, right? So that's the math. I say it all the time. All the time. Most people are terrible stock pickers because you don't have a business background. Can't run financials. Can't tell me what does a good balance sheet versus bad balance sheet look like. Can't walk through all the financial ratios. Can't tell me about free cash flows. Why is it important for a company to have free cash flows? Same reason it's important for you to have free cash flows as a person, your personal finance. All right. So this stuff is complex. It is. It really is. And it's not easy. You never see me trying to say I can pick. Because what you also notice, it's like, I don't know. It's tough. And then who keeps a record? Right? Who keeps a record of what you called? I would love to see somebody say, I'm gonna put my foot in the sand. Somebody on MSNBC, the big shows, it don't matter, whoever. I would just love to see more people who that's their thing. Pick the 5 stocks today in 2022 that in 2032 are going to be killing the game, that are going to be dominant in their industry. All right. That's not easy to do. I said 5. There's thousands of stocks. All right. Now, Dow Jones is 30. S&P is 503, even though it's the 500 at 503. NASDAQ is 102. All right. So it's really the same little 500 companies are really the good ones, All-Star team is think of the NASDAQ, the Dow, and S&P as an index. As an index. Think of those indexes as like the All-Star team. It's how I used to teach my kids back in 2010? I was trying to explain indexes and I was like, man, I couldn't figure it out. And then I was like, look, they're the best of the best. And then somebody was like, oh, you mean like an all-star team? Yes, young man. You come up and teach class. Yes. Like the all-star team. Okay, let me keep moving. So we talked about trends. I showed you some of the tech stocks. Oh, let me show you real quick. Microsoft. Right now, where we are, Microsoft is down. I mean, everything's down, but y'all know what I'm trying to show you specifically. Specifically, because I just covered it. Down 38%, under that 20. Squeeze is red, right? We got lows of the recession here. I mean, lows of COVID there. We got stuck back here for a little period. This was October is always like, you know, October, November, September, October, slow months, right? So we froze up a little bit here. So we might have a little support at 200. Might have some support at 200. We'll see. But right now, we're bearish. That's all I want to show y'all. I don't want to get into no debates with nobody. We're bearish. Anybody saying anything other than that, leave them alone. It's ego. It's ego and hope. We're bearish. Here's Beyond Meat. What happened to Beyond Meat? Well, got a really nice pop. Because I don't know, you know, COVID jumped it up 357%, which is amazing, and then it came down 95%. All right, that's tough. And here's the thing about these two: the Beyond Meats of the world, the Cloroxes of the world, the DraftKings, Peloton, Roku, Zoom, those. They all moved when the market was moving. When the market was, you know, they were on pace with the market, 100%. But were they on pace before COVID? No, not one of these COVID stocks that we were all enamored by a couple years ago. If you really just step back, month chart, and gave it an objective look and said, has this stock been doing as well as the S&P? Has it just been following along with the broad market? No. So COVID was very special, and certain stocks got a bump because of human psychology, because we're at home, because of all of those reasons. But were they fundamentally great companies that became great investments because of COVID? No. And you see that now. You're seeing it now. As everything just is already back to its COVID lows and worse and lower. So, you know, I'm not saying don't look at these. I'm not. Some of them are probably great value. But I'm not paying attention to any of them. As a minor statistician, like without the PhD, but I love stats, you know, and can, you know, got A's in stats. To me, this is like, I don't know, man. Like I go into a restaurant. If you ever are around me, I go to a new restaurant, I look at the menu, but I'm really not looking at the menu. You know how I order? I ask the waiter what's their favorite meal and what's the most popular thing here. If I literally only come to this restaurant one time, what should I order? It's a question of probability. I'm trying to give them to give me the highest probable return on my money. Right. So these types of stocks, to me, these are the stocks that, you know, you got that section of the menu where like, oh, it's all of the best, like the chef's favorite. These stocks weren't even on like the chef's favorite part of the menu. So why were we so enamored by them? They were great trades. Yeah. 357% return. Great trades. But if you thought these would just continue to dominate, they weren't dominating in the first place. Right? They just weren't. Let me see. I'm gonna pull up a few more real quick just to show y'all. So keep Zoom. Look at Zoom. Ew. Huge fall from Grace. Clorox. I got all kind of stuff on this chart. But this big triangle right here, everything is doing this triangle. COVID lows, really big pop up all the way back down to COVID lows. You're going to see that. You're going to start to see that on a lot of stocks. Back to the COVID lows. Oh, did I do Zoom? Oh, that was Zoom. That was Clorox. Oh, Roku. Roku, huge move. Right back down, same place. And you know, if we're talking about purely like price, then yeah, a lot of these are technically at their support prices, and it's like, so you could argue that they're at great prices now. But then you got to think about time frame and dominance. And during this crash, how have they been holding up? Because the market is not back, right? The market is not back down to its COVID lows, but all of these are. So clearly that's telling you something. These stocks have pneumonia. The market got a little cough. Little cough. Right. And this is where that logic comes into place. A huge part of this thing is really like just staying away from bad stocks. I won't even say bad, but stocks that are underperforming, that are moving twice the pace when we have bad markets and good. You got to be aware of that. We start talking about the speed at which a stock moves. What is that even called? What is the term for that? What is that? How do you compare? The S&P moves at 100 miles an hour. What is Tesla's speed? What is Apple's? It's called the beta. I got that in undergrad and then again in B school. All right. And then I learned how to apply it here. And I was like, oh, this is where the beta comes in. Okay, cool. Okay, cool. All right. Let's see. What else? Oh, let me show y'all this Fed report. So this was yesterday. Blah, 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 blah. All right, let me see. Show y'all this. So this was yesterday. Because I don't want to get rid of that. I'm gonna show y'all on the MES. It's the same thing. It's the smaller futures. I want to show you on a 30-minute chart so you can really see it. So this is what happened yesterday. Actually, there was a trend line up here too. You know, not to get too technical, but I had a trend line here. So it perfectly hit that trend line from several days back, and then another several days back. All right. 30-minute chart. The market pretty much on these days where, you know, Jerome Powell is going to talk about interest rates, the market just kind of freezes. I usually don't trade on these days because we get this. We didn't go nowhere. I can't make any money in this. There's no trend. All right, we ain't go anywhere. All right. Then the market takes off. Market pushes up. And I'm like, we ran right to this trend line. Are we going to break it? And we started coming down. Now, I wasn't trading, but I went back and looked at it later. And yeah, we made new lows, right? So initially, first part of the conversation, market started to react positively. But by the end, as they got further into the numbers and we Powell started talking about slower but not lower, the market started pushing back, going lower for the day. All right, for the day. Already inside of a downtrend. All right. Matter of fact, let me take all this stuff off real quick. So this is the S&P futures, which kind of don't even worry about what futures are, but because I don't really want to explain it right now, but futures essentially is like a leading indicator. It's bigger money. Every one of these S&P contracts, it on Thinkorswim may cost you $14,300 to place a futures trade, like to have that much margin in your account. You need $14,300 for the ES. This is the little baby one. There's a little small one. You can practice on this one and learn how to make money. Then you go to the big one, right? But that $14,300 is essentially giving you. Let me do the math. What were we at today? 37.50. It's a multiple of 50. So 37.50 times 50. That's $187,500. So for $14,000 with futures, you're actually trading $187,000. It's called leverage. That's all options is, just leverage. Futures, leverage. Options, leverage. Foreign exchange, leverage. But can you read a chart? You can't do this part. The leverage ain't gonna help you. You're just gonna lose money faster. Oh, I got somebody posting free girls chat. So let me block them. Let me block them real quick. Okay, cool. All right, so as you can see, right, futures just real clear, man, really clear, because we're just riding that little trend line. And I think that trend line that I drew, yeah, that was this one. All right, so this little spike here, and we try to get above the 20 on a day chart. 913, you connect. This one here, look at that. This was what, 816? This was 913. Over a month later. The line was already on my chart. It should have been on your chart. This is like 101 stuff. It really is. It really is. Like you should know. You should know every time the market moves, you should know where it's going. There's some place that the market is trying to go to. An old low, a 20, a trend line. There's something we're going to. The market is never just like, it's so much more organized and efficient than people think. It's always going somewhere that is organized, is clear, is predictable, has a certain amount of probability to it based on the overall trend direction. It does. Oh, let me show y'all these and then see. If you got any questions, feel free to type them in because you can actually interact with me. I meant to say that earlier. I usually will be like, yo, what's up? And give a little shout outs to people. Let me play my music for a second. Yeah, this is actually an interactive show. I didn't make it interactive too much today though. But if you're watching live, which you are, yeah, you can actually you can type in, let me know where you are. You can type in a question. If you wanted me to look at a specific stock, you can do that too. Why you got me? I'm gonna show you these 200s. These 200s are important to see. Where did I have them? No, let me see. Nope. Where is it at? I gotta find it real quick. Huh? Yeah. Oh, there we go. Okay, I gotta take this off my chart. I know y'all can't see my chart. I'm gonna pull it back up in a second. Just trying to clean it up. I'm gonna show you everything. Give me 1 second here. 1 second. I want to show you this. This is important. Oh, why did that do that? Nope. That's not what I wanted. Oh, okay. Here we go. Oh, got it. Okay, my bad. Okay, so let me show you these really quickly here. Fade the music to black. So, this is important. Investors and traders both should know about the 200 period moving average. It's a technical indicator. All it is if you essentially take 200 days or periods, bars, whatever you call them, add up the closing prices, divide by 200, and where to plot that line, right? It's telling you something. So this line here, right up here, same place where we actually connected that trend line. So if I go back for a second, matter of fact, I'm gonna take these boxes off. Take these off. All right. So market pushed up to test this 200, and then we faded. All right. So we tested it, hit it perfect. That was it. There's prices there. There's orders there sitting there that the market wants to sell, wants to activate. All right. So if I go back here for just a second, and then I redraw that trend line. All right. What you'll see that you can't see on the week chart, what's actually happening if you go to the day, you'll see that price pushed up during this little uptrend, right? To do what? Just to get to the 200 to test it. And then we faded. And then we went down to the 200 on the week. So this one up here is the daily 200. This one is the weekly. All right. If I go to the week, why is the weekly so important? Because this low back here in 2018, all right, perfectly bounced off the 200. It's just a big technical signal, big institutions, if you're dropping way more money than normal people we're talking about, right? Then clearly right? You definitely have a propensity to want to get better prices, right? So these long-term indicators, health indicators of the market, they matter. During COVID, look at this. During COVID, we dropped under this weekly 200 for just what, 3 weeks, came right back above. All right. So this entire year, right? As soon as you say, well, dang, where are we going? You kind of want to have an idea of where the 200 on the daily and the weekly are. And it's real quick to just see it, but these prices matter because big institutions who have way more money than average retail traders, it matters to them. So it should matter to you. All right. And if I go back, let's say I go back 20 years real quick, you just get the like broader view. Look at that. This low of 2018 bouncing off the 200. This low back here in 2016 touching the 200. This area here, remember we talked about this? This was that 2-year period where we dropped. This was the recession. When we pushed up this 1 year, where did we go? Look at that. We perfectly went to the 200 and then we just kind of faded for a second. All right. Y'all see that? Right here. And then we just were in this range for a while. Then we got above it. Came back to touch it again, bounced off it there, and man, that was it. Look at that. If you bought back here, oh man. And once again, you didn't have to do that. Because you could just buy every month and keep it real simple. You know, you can dive into these technicals, as we think about like long-term investing, right? Yeah, you need those longer term views. Sure, of course. Of course. And where are we right now today? Well, let me just go back to a basic naked chart, just a clean chart. All right, where are we at today? We ran up to the 200. All right, we just bounced off that little minor trend line that we had like right in here. This week is pushing back down. We got 1 day left. Tomorrow we have a jobs report. We get those. I think that's once a month. I should know this, but they come out before the market opens. So I used to get up early and try to trade around them futures, but that's too. I ain't got to do all that. Plus, I'm just older, so I don't want to wake up super early just for one trade. Let's see. Henry said, my question is, why is UVSY not moving up if the whole market is going down right now? I have no idea. Let me look at UVSY. Let's look. I don't even know what UVSY is. Is that the right? UVSY. Let me know what you meant because I typed it in, but nothing comes up. So I don't know. I don't know what UVSY is. It sounds like probably some sort of inverse index or something. Because his question said, why is it not moving up if the market is going down? Inverse relationship. Matter of fact, let's talk about that real quick. So there's ways to make money. Like, okay, so ARK. So there's a set of managed funds called ARK. It's like ARK. It's a whole bunch of different ARKs. Kathy Wood. Is it Woods? I think it's Kathy Wood. Kathy Wood is the manager. She was at some company like 18 years before. A lot of people were in love with Kathy. I won't say they're not, but she was like the darling of Wall Street during COVID, which was the steepest uptrend of like the last 30 years. Every fund manager should have been up. I'm just saying. But ARK K is one of those that was really popular, heavy on tech, and she was just, man, every other week she was in the news, her predictions, and I'm buying more Tesla, I'm buying more, blah, 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 blah. Right. ARK K is pretty much, it's recessionary. It's already experienced its recession. It's back to the COVID lows. I keep telling y'all, back to the COVID lows. Right. If things get much worse for the broad market, right? Some stocks have already done it. So it's possible because a lot of stocks have already done it. Right. I didn't know, but I found this the other day. There's something called this is, think about how crazy this is. This is a firm that, right, you have a fund manager with teams of analysts, really smart people, and they're putting together their best ideas on which stocks to get in and out of that to create this fund, this basket of assets to help people like me and you make money by investing in those and making money as they make money. So technically they're doing the work for us. Technically, right? By making those selections. Then another firm another firm made an index that was designed to move inverse of the ARK fund. It's called SARK, SARK. So what you'll notice is SARK is actually up. Or at least we'll say it's not down. All right. That's my mom. SARK is actually up. All right. So let me do these. I want to compare these two. This is going to be a little trippy just for a second, but let me see if I can make this work. I'm gonna put the month charts on. And then I want to go to, I know this is a little confusing. I'm gonna break it down. Hold on, give me a second. I got up SARK. Oh, and then I'm on ARK. So the red is SARK. So you see that? The red one, right? These are inverse. This one's going down while this one is literally going opposite direction. You can see it perfectly here. All right, slowly went down, this slowly went up. And right in here, you can actually see, I mean, we're not at brand new highs. So it is correlated to do exactly what I said. But because the broad market itself is getting beat up, right? Even this that's an inverse is struggling to, right? We're just really ranging. And this is ranging too, right? So technically both are ranging. Let's see. Somebody said, Noble, what's up? Mad late. It's all right. I can't see who, the person's face. I don't know who it is, but it's all right. It's streamed live. Hit the button. You can watch it later. You don't miss a thing. You don't miss nothing. Let's see. Henry said UVXY is VIX short futures. So let me ask you this. Are you, well, as you just went to let me just pull it up. UVXY. Make it a clean chart. Pro shares, ultra short term futures ETF. Let me go to the week. I'm not gonna lie. If I pulled up, it would take more time than I really have or want right in this moment to explain fully. But I'll say this. I know the VIX, as you know, has an inverse relationship with the market. All right. So generally speaking, matter of fact, let's do that for a second. Let's have some fun right there. VIX. And let me pull up SPX. Yep. So here's what we know about the VIX and SPX. I know this is a lot on this chart. I know. But this is the only way I can show it when I'm comparing these two. So let me take some stuff off for a second to make it a little cleaner, just a little bit cleaner. I think if I go here, okay, I could zoom in a little bit more. Okay, there we go. That's probably as close as I can get. All right, so this here is the VIX. This is the S&P. There's an inverse relationship. All right. So if you look at all these bottoms here, when during COVID, once again, easiest year of our lifetime. I'm gonna say it. Whether you made money or not, I don't know, but I gotta say it, right? Strongest, steepest, cleanest I've ever seen. I don't think you can find a year that's better. Cleanest uptrend we've seen. Right? The blue candles. S&P. Every one of these little dips, every one, connects with, not perfectly, but sometimes it's perfectly that exact same week. Sometimes it's like we'll get a little second test, right? But it's connected to the VIX jumping up to like 32, right? So there's an inverse relationship. VIX pops up to 32. The way that the VIX was designed. Oh, let me say what the VIX is. For those that don't know, it's called the volatility index. So think about volatility, right? It's volume coming in, how fast things are moving. We got low volume, it's not a lot of buyers. A lot of volume, that's like going in a store on Black Friday. That's volatility because there's a lot of people in the store. And there's a lot of people in there trying to get those prices, right? The next Thursday morning, no specific sale, nothing special. It's a few people in the store. Low volatility, right? Low volatility. So this volatility index is what, man, I could teach a whole class on the VIX. It's that important because what it's measuring is S&P contracts, S&P options contracts, 16 and 44 days into the future. Why does that matter? Because if you're a billionaire or a millionaire or whatever heir, and you're worried about your portfolio losing money, then how do you hedge against that? You buy puts. So if the market does come down, you can make money in the options market. That kind of balances out a little bit, right? You don't have to get out of every single share of everything you own because, oh my God, the market's coming down, right? So we're talking about two different things. Now we're talking about investing and trading, which is why I think every single adult needs to learn options. I do. I really do. Because you don't have to be some options day trader. You don't have to even swing trade on a daily. You could literally use the month and a week and do very well if you're patient. Right? You don't have to be no day trader. Most day traders don't make money anyway. It's the big secret. Like 95% of day traders don't make no money. Right. So this volatility index, it tells us what people are. It almost gives us a really great indication of fear as well as hope. Right. Because you got to think about it. When we were getting these little spikes during COVID, during this great bullish run, every time the VIX popped up, really good time to buy. You could literally see it on the chart. Good time to buy. But then this year we turned into a downtrend. So it gets a little bit more complex because now we're in a downtrend. So do I want to buy the dips when we're in a downtrend, or do I want to sell the rips? Do I want to sell the highs, or do I want to buy the lows as a trader? As a trader, you want to go with the trend. All right. So the extra little piece of this, to answer your question, that's a little tricky right now in this moment, is the VIX is usually actually like really tight. It's gonna hit these little, somewhere down around 20, 15 at most, 30, 32, come right back down. All right. So generally speaking, it's very tight. What you're experiencing right now, which answers your question, which I don't know if it's fully gonna make sense to you, but I'm gonna say it. The VIX is just finally kind of in a different place. And it's in the same place where during the last two major recessions, when you don't see the VIX responding how you think, it's because the VIX itself is expanding a bit, which means we can actually start to get much higher ranges of volatility. So basically what I'm saying is this is where if this was 2008, this is right around that period where the VIX started to go a lot higher than 30, 32. Right. And the 32 is important because the way the math works, it's a factor of 16. So take 32, whatever the VIX is, divided by 16. That tells you how volatile the market is. 32 divided by 16 is 2. That tells you we have a 2%. We're expecting the S&P to have 2% volatility. You can get a 2% drop. All right. It's just more volatile. We get up to 48. 48 divided by 16 is 4. That's when we had those huge down days. The market can drop. It can move. All right. So the volatility index is what you're gonna see on every major news show. Any decent trader, and I would say good investors, need to know about it too. So you're not seeing what we normally see for two reasons. One, we're in a downtrend, which is opposite of the norm. Most of these years the market has been, we haven't been in a downtrend. I showed y'all like a 20-year uptrend. All right. COVID was too bad. I mean, not COVID. The recession was like a bad year and a half. And then we got a 12-year bullish market. All right. That's why I be trying to show y'all like the real view of this, right? Just for perspective. But once again, so we're in a down market. So the trend has changed. So that affects how you look at the the VIX. And then the VIX is actually starting to expand, or at least has the potential to really expand and not just do that little 32 to like 20 range. So we'll see. We'll see what's coming. We will see what's coming. Go back here for a second. So that was a lot. I'm an hour and 10 minutes in. That's about enough time. I want to see what happens kind of at the close. Plus I need to go eat. So thanks for joining me. Once again, this is Noble, just trying to bring you some solid, insight analysis. I wanted to cover a lot today. We went back and looked at 2008. We saw these huge 20-year bullish markets. I started this by going back to 1929. So we talked about trends. We talked about how tech is down and getting beat up, and a lot of those stocks are already in their recession, back to pre-COVID lows or worse, like your Facebooks, Netflix. Apple's one of the only one. Apple just does its thing. You got to be impressed by Apple. I'm sorry, you do. Microsoft is down, Meta, Amazon, Google. Those pre-COVID stocks that got a really great run, the Roku, Zooms, Cloroxes, all of those, they're getting beat up incredibly bad. I want you to be careful and really commit. If you're going to commit to them as a buyer, as an investor, really commit. Because if the market gets any worse, what are they going to do? All right. When they're already in a recession, what are they going to do? All right. So patience is always a thing. Patience. You talked about these Fed reports. You saw it pop and then it came back down yesterday. That's inside of this longer macro level bearish story. Once again, we're still bearish. We're still bearish. We are. We got the jobs report tomorrow. We got midterm elections coming up. If you go back, you want to have some fun, pull up a month chart, go back and look at the midterm and presidential elections just to see what happens around November. Go back and look. Go back and look. You should. Yeah. And I showed you the weekly and the daily 200 major indicators that you have to be aware of. And then we also talked about, this is a game of probability. The markets are about uncertainty and variation. When you are analyzing and interpreting data, which is what price charts are, it's data. You're a mini statistician. This is data analysis, right? So don't miss that. I wish you well in your trading. And as I always say, share this video with somebody that you know and that you love who needs to get a bit more serious about their wealth, trading, long-term investing, and really get some solid insight from somebody who's legitimately spent all of my 30s connected, glued, making, losing, learning, loving the journey. Thanks for watching. Oh, let me see. I think somebody said something before I go. Oh, I don't know who that is, but somebody said thank you. No problem. You're welcome. You're welcome. You're welcome. You're welcome. Talk to y'all later. I'm in a live. Let me say this last time. I never advertise my own stuff. I'm in a live 8-week. This is week 4 of my 8-week live options class. It's called Limitless Options. I'm heavily thinking about, how the year starts. It's a new year. Depending on where the market is, we either will crack these lows. We'll be, or we might, and it's possible. It's definitely possible for the market to push back higher. It's possible. All right. But is it probable right now? That's what you got to ask. Anything's possible, but what's most probable right now in this moment, as of today, as of this video? We're bearish. That's all I know. That's all I know. And that's trader me speaking. Because once again, I also showed you long-term investing. Stop making it too complex. Stop making it too complex. NASDAQ, XLK, they're tech-focused indexes over the last 10 years. Those two beat everything. And I don't care who you are. You're not beating on an annual basis. You're not beating XLK or NASDAQ. You're not. Because fund managers with teams of analysts and MBAs like me can't beat it. So, just data, just logic to help you make your decisions. That's all I want to do. That's all I want to give you. Thanks for watching. Love you guys. I appreciate you. Share this video with somebody you know you love. Sign up for the channel, all that good stuff. Y'all know. Sign up, subscribe, all that. Oh, that's what I was gonna say. Beginning of the year, I'm thinking about it right now. About doing potentially maybe another options course. I might do a futures course because that's really my heart. That's my obsession. Like I've been obsessed with futures for so long. I know it like the back of my hand. My system's amazing. I might even do both. Might do both. So we'll see. Stay tuned. Keep following. Appreciate you guys. Peace.